All right. Good morning, good afternoon, traders. Today is Wednesday, January 29th, 2025. This is You've Got Options for Income Navigator. First thing we're going to do is we're going to look at a chart of ES. This is E mini contract, and we'll look at volatility, maybe look at gold and oil, and just kind of get an idea of what's happening. I'll share my thoughts. Maybe that will help you with making decisions about taking new positions or how to go about managing your ongoing positions. So with the S&P, we last couple of days, right, we see market going up and down. We had a pretty decent gap on Sunday night. Monday, we came down all the way on ES down to about 59.48. We rebounded, which left like this pretty long shadow. Yesterday, we saw an inside day, right? So not piling on more selling to the downside here. I think was kind of, I don't want to say bullish, but it was definitely not bearish. Another thing I want to point out is that as the market was selling off on Monday, one underlying or one kind of silver lining was that we weren't seeing ticks at minus 500, meaning the selling wasn't broad selling in the market. So that kind of made me believe that there was just a handful of sectors that were putting pressure on the markets, and as we know, tech was the reason why the market was down. And yesterday we saw a quick rebound. Today we have the Fed decision. As expected, they didn't move. Didn't listen to their press conference. I believe it may still be going on, so I'm not really sure what's happening there. But as we can see, the market's kind of undecided which way we want to go. I don't think that the Fed is expected to move until I think sometime maybe in the summer. I think the odds of a quarter point cut in the summer is somewhere around 50%, or at least that's what it was before 2 o'clock, and that was the last time I looked at it. So it's really, we can't make a decision. Are we going higher from here? Are we going lower? We don't know. But, just looking at this chart, we had a pretty decent push higher, and we can look at, I think this was like a 6% move up. We did. Right, so it was 6% in 11 days, and then we came down in just literally 2 days. We came down, but we held the 61.8 Fibonacci retracement level. We came back up, and now we're still above this 21 EMA. So I can't really say that this is bearish, but maybe we are putting in some sort of a bear flag, and maybe there is another leg lower. In the grand scheme of things, we just want to see price hold above this swing low, which will be just another, pullback, and then potentially take out previous swing high. And this is what defines an uptrend. If we start to see a series of lower lows, then maybe this most recent swing where we came down, I think we might have matched the previous high or very close to it. But as we can see, we kind of ran out of steam here. If we come down here, we come back up and we can't take out previous swing high, maybe the trend is shifting here, and we can start to think about potentially going from an uptrend to a no trend, which is still fine. I think income trades are going to do really, really well. And it's too early to decide which way we're going to trade next. But for right now, I think as long as we stay somewhere above 21 EMA, I think we're going to continue in the direction of the trend. If we lose 21 EMA, then we could potentially think about trend change, and we'll see what happens at that point. Looking at the VIX isn't really doing too much. We had a big spike on Monday. Volatility came right back in. VIX is at 16.7, so not too much going on in the VIX. I was looking at gold. And to me, gold is just, trading in this channel here. I think, we talked about potential trade setup as a strangle. I still think it makes sense. Reason being is that, a strangle will possibly give you a short delta to start. I modeled a few trades, and to me, right now, I still think that the risk in gold is to the upside because if you just, you know, put together a strangle where you have your short call same distance away or same distance out of the money as you would set up your put, right? So, for example, gold at 27.73, maybe you go up 100 points, down 100 points and you will see that calls are more expensive than the puts. So I'm in the camp of thinking that the market is viewing risk to the upside rather than to the downside right now. So if you wanted to set up some sort of a strangle, you would probably want to, make your strangle not just equidistant, but you also want to collect about the same dollar amount for both short call and short put. Because if you don't, you might end up in some sort of a skewed strangle and you need to understand what your starting delta is and then if that will align with your initial directional outlook for your trade. With oil, yeah, oil is still continuing in the same channel here that has been in place for quite some time. This is going back to October, right? It's pretty decent swings up and down. I think strangle would probably make sense, right? Until we break out above, let's call this most recent swing high. So let's call this 80. Above 80, I think strangles make sense. We get a big push higher. Um, as we know, strangles um, to the upside usually get hurt a lot more than if the asset is moving to the downside. But right now, we're kind of in the middle of nowhere. So I think strangles might make sense here. Um, what I mentioned last time, my trade idea, which in hindsight wouldn't be great, but I think it would still potentially work here, is to set up a strangle and use some of the credit from the short strangle to pick up a call debit spread because I do think that at some point we're probably going to see break out of this channel. And I think that the risk in oil is to the upside, not to the downside. I just, looking at this chart, and again, it's kind of hard to predict what's going to happen next, but as we can see, there's pretty decent support somewhere in the mid 60s. So I think that it's more likely that we go higher than below 60. And if we do go below 60, obviously you need to have a plan for it. But I think that selling a strangle and using some of that credit to finance a call debit spread is a pretty decent setup. So let's hop over and look at some of these hedged income trades. And if you have questions, you can ask in the chat. I'll try to answer as we move along and hopefully not lose everyone in the process. I have a number of these hedged income trades. I mean, I refer to these as 1-1x because they are. There is a 1-1 and X being a number of short naked puts. Sometimes there's two, sometimes there's one. And, when I say sometimes it's this and sometimes it's that, it's not to confuse anybody, but you have to trade what works best for you. If you're not comfortable having, two naked puts for every one put debit spread, maybe you're more comfortable with only one naked put. It's still a 1-1x, whatever you define your X. Maybe it's a one naked put. Maybe you feel frisky and you want to put, something like a one put debit spread with four naked puts. So it's a 1-1-4 trade. It's still a 1-1x. The difference for me is that, we don't necessarily have that bear trap that we had before, just looking at the risk profile of this trade. So I don't want people to focus on the trap because to me, it sets up like this false sense of security that, when the underlying asset starts to move lower and the trade is starting to run into trouble, sometimes we look for reasons to ignore our trade plan and to break our rules and we see this big fat trap that like is, I don't know, 2 months away, right? And we say to ourselves, well, you know what? We're maybe at a loss right now, but it's okay because we're now just starting to enter the trap. So it's going to be really nice, and I'm going to buy me this, and the other with the profits from the trap. But the reality is that, if you have two naked puts, that is where your risk is. Don't worry about the trap. If the price is going to end up in the trap, it's not because you can do anything about it. You're not controlling the price. You could only worry about things you can't control. What you can control is how much heat is your trade taking with your naked puts. And if the trade starts to get into trouble, your job is to defend your position, make whatever adjustments you need to make to stay in the trade long enough, right, to potentially make a profit. Uh, this trade here, I started. So this is the most recent trade. You can see it was from 2 days ago. The price is up about zero point 0.7 standard deviations from where I took the trade. So it moved quickly to the upside. Doesn't mean a whole lot. I put this on Monday when market was down. We could have been lower, and it is what it is. I don't try to time these trades, but question about Manuel. I'll get to this in just a second. So my setup here is it's a one put debit spread with two naked puts. So I put my naked puts, right? 2 days ago, they were at about 53 days until expiration. I like to be somewhere between maybe as low as 30 days, as high as maybe 60 days, somewhere in that window. Maybe it's 45, maybe it's 47, 53, 56. That could be all over the place. And the reason for that is, once I have multiple tranches going on, and if I try to place my trades every single week, I don't want to step on or make my new trades too similar to the trade I might have taken the week before. Or if I'm putting on the trade where my short strikes would be on the same exact strike in the same exact expiration 2 weeks later, right? I would rather give myself a little bit more time, just move away. I don't want to continue to add multiple tranches on the same strikes in the same expirations. Kind of becomes a little bit of a mess to manage the trades. So, does it make a big difference in the end? I don't think so. Right? I mean, there is a difference between going, 45 DTE and going 90 DTE, right? But the difference between 45 DTE and 53 DTE, you give it an extra week or so, it's not that big a deal. What happens is the longer you go on the short strike duration, the longer it'll possibly take you to get to your profit target. So you will be in the trade longer, right? That's kind of, I mean, I don't want to call this, a bad thing. That's the downside, right? So you're going to be tied up in the trade longer, so you get slower decay. The flip side, the positive, is that by going a little bit farther in time, your buying power requirement is going to be a little bit lower. Now, that could also lead to potentially getting too or using too much leverage and getting overextended, right? Because if your broker is requiring less money to put up front to get in the trade, which leaves you with more buying power, now you're starting to think, well, I have all this buying power that's just sitting there not doing anything. Let me put on another trade. And before you know it, you stretch yourself too thin and one thing goes wrong and you are in trouble. So I try to keep my trades somewhere, between 30 and 60. I know it's pretty wide. So, 45 days is a good starting point. And maybe I will not hold, right, my short strikes all the way, or the naked puts. I'm not going to hold them all the way to expiration. If I'm starting the trade at 45 DTE, maybe I'll look to get out of the trade in the last week, maybe in the last 2 weeks. So I'm only going to be in the trade for 30 days. As a rule of thumb, I think this is a good starting point for everyone that wants to kind of pay attention and maybe model similar trades and use this in their own trading. The idea here is to sell a to sell naked puts for about $25 credit, right? So selling two puts at $25 will give me $2,500 credit. And then I'm going to buy a put debit spread, and I want to spend half of the credit that I'm collecting. So if I'm collecting $25 and I have two of these puts that I'm selling, that means I could spend $25 on a put debit spread. So that leads me to the next step, which is okay, where is my put debit spread? In this trade, I chose to go with September 30th, and you have to be mindful that sometimes these contracts fall on a monthly expiration. So they have a monthly and the weekly, and they may be in the different futures contracts. So you have to, if you're using Option Explorer and then you're using a broker, you kind of want to pay attention which contract exactly are you going to use. So September 30th is not one of those contracts. I think this is a quarterly contract. Doesn't make a difference, quarterly or monthly. Just pay attention so that you know what are you trading, because sometimes you can have two contracts. For example, September 19th. I think this is one of those where one is in a September futures contract and the other one is priced off of December or something like that, right? So as you can see, both of these, for example, have 233 days, same exact strike, 6,100 on the call. This one is going for $318. This one's going almost $40 higher. That's because they're priced off of a different futures contract. Anyways, I went with 200 and this was 246 days. So maybe I'm going to go with something as close to 250 days as possible, right? You can go to, 150 days. You can go to 180 days. You can go to, whatever works best for you. For me, my idea is to get as much time as possible. I probably wouldn't go to like 400 days because number one, liquidity may become an issue, right? There aren't many market participants that want to trade options that are, 400 days away. So I think this is probably as far as I would go, somewhere in the neighborhood of about 250, maybe 260 days. And I'll tell you exactly why. What I'm looking for. So once I choose which expiration I'm going to go with for the put debit spread, now I know I have $25 to spend on a put debit spread. Now we can set up a put debit spread in many different ways. Let's have a look. For example, if I was setting up something today, right, we're looking to spend $25. So if I chose to go with maybe a 5,500, I'm going to buy one of these, right? And I'm paying 111, whatever that number is, right? This is a good exercise, and you should, definitely practice this just to get an idea, how to go about selecting different strikes and how to model these trades. This way, when you're going to go to set up your trade, you kind of already have gone through this exercise a number of times. So it's going to become a little bit easier and you'll be able to put things together a little bit faster. So if I'm buying a 5,500 for 111 and I have $25 to spend, that means I need to sell something for about $86, right? To make this a put debit spread for a debit of $25. So I'm scrolling down, I'm looking for a put that is currently going for about $86. So in this case, it's a 5,300. So if I sell one of these, right, I'm in a 200 point wide put debit spread. And this put debit spread is currently going for, close to $25. It's $23.75. Now, you may not get a fill right away, right? So maybe you have to go up to 24, maybe it's 24 and a quarter, right? Because these aren't priced in nickel increments, right? Every tick is 25 cents. So you wouldn't go from, like, you can't get 23.60. You'll have to go 23.50, 23.75, 24, 24 and a quarter, 24 and a half. So you're looking for a put debit spread for $25. In this case, if I'm using these strikes, I'm going to go with a 200 point wide. Now, 200 point wide put debit spread, as you can see, right? It's less than a one standard deviation away, right? So it's not too far out of the money. Our long leg is about, I don't know, 7% or something out of the money. It's not terrible, right? But it's only 200 points wide, which means that the narrower, right? The narrower the spread is, the less the less effective it's going to be. It doesn't have enough short delta. See, a 200 point wide, we start off with about delta -2, right? What if it wasn't a 200? What if it was a 100 point wide? So we spend less, right? This one's only going for $12.50. So we spend less, which means we're going to start with a higher net credit. Remember, we're selling 2 naked puts for $25, right? And then we're only going to spend, right? So $25 for the naked puts. That gives us a total credit of $50. And then instead of spending half of it, or $25 on the put debit spread, we're only spending $12.50, which gives us a net credit $37.50 divided by 2, because ES contracts are they have multiple of 50, not 100. So we get about $1,875 credit to start. So if we go narrower on the put debit spread, yes, we are going to collect more money up front, right? But the put debit spread it's now only 100 points wide, which means that it may not be as effective, because now you can see we just cut our delta from -2 to -1. So we're going to start with more positive delta. Our put debit spread is going to be less potentially effective, because if the market does, let's say, go down 4%, it's fair to assume that a 200 point wide put debit spread is going to be worth more than a 100 point wide put debit spread. I hope everybody could understand and agree with that. I'm going to repeat this. If the market goes down 5% in a week, we're just comparing two put debit spreads. We're comparing a 200 point wide put debit spread and a 100 point wide put debit spread. Very similar. They both have the same long leg. If the market goes down 5% next week, we have to assume that a 200 point wide put debit spread is going to be worth more than a 100 point wide. Right? Because our short leg that's offsetting the profits from the long leg is closer in the 100 point wide put debit spread than a 200 point wide put debit spread. So 200 point wide costs more, but in the event the market goes down, it's going to increase more, right? So there's a trade-off here. With the narrower put debit spread, we put less money up front, but in the event the market goes down, it's going to increase less, right? So there's an offset there. So what's the right width, right? If, let's say, I wanted to spend the same $25 for a put debit spread, but I wanted it to be wider than 100 or 200 points, right? If I wanted to be wider than 200 points and I didn't want to spend any more than $25, then I will have to move the whole thing lower, the long and the short, right? So my longs are not going to be at 5,500 or a delta 18. I have to go down. Let's see if we go down maybe 500 points. So from 5,500, we go down to 5,000, right? So now we're at delta 9.8. We buy one down here. We're spending $59. Remember, we're buying a long put for $59. That means we need to sell something for about $35 to keep the distance, or keep to make the difference in the price between these two options 25 points or $25. Right? We want to spend no more than $25 for this spread. So if we're buying a put at, let's say, 60 minus 25, we need to collect $35 someplace to get our cost of this put debit spread no more than $25. So now we're looking at 4,500. Okay. So now this spread is going for 24, again, 24.75. You may not get a fill. You go right to 25, but we're within our target, $25. That's what we want to spend on the put debit spread. Now, this is not where our edge is. Is this $25 a magic number? It isn't, right? You have to figure out what works best for you. You can look at what I do. You can look at what Tom does. You can look at this, that, the other, right? And then you can try with different widths for yourself to see which one works best. Now, sure, you can make the case that, maybe if the volatility is high, relatively speaking, it's more advantageous to go with spreads that are closer at the money. Or if the volatility is low, you go with spreads that are farther out of the money, right? But in general, the rule of thumb for me as a guideline, if I'm looking to spend $25 for a put debit spread, if I place it closer at the money, it's going to be very narrow, maybe at 100 points, maybe 200 points. If I want to have a really, really wide put debit spread, then I have to push the whole thing farther out of the money, which means that if the market was to go down 5% next week, right? This put debit spread, even though it's super wide, right? We have to assume that it's going to increase in price. We don't know exactly how much it's going to increase because volatility is going to come into play here as well. But just looking at the Greeks again, we have a 500 point wide put debit spread that starts off with a delta of -2. It was very similar to maybe having a 200 point wide put debit spread at a delta 18. The main difference between a 500 point wide that is like, I don't know, this is about 15% out of the money, right? This 500 point wide put debit spread that's 15% out of the money, if the market is pulling back but slowly, right, it's not going to be as effective. We're going to need to, in order for this put debit spread to really increase in value, we're going to need the market to move with some kind of speed. Right. So I'm not making the case that one is better than the other. I'm just putting out, these are facts, right? That if the 500 point wide put debit spread is farther out of the money than a 200 point wide put debit spread, if the market is moving slowly, the narrower put debit spread is going to do better. If the market is, full panic mode, we're down 7, 8, 9% in a week, the 500 point wide put debit spread is going to do better because we have a little bit more gamma and the delta is going to increase a little bit faster. So this 500 point wide put debit spread has more potential, or has a potential to be possibly worth more if the market's going to continue with the same speed. Right. So you kind of want to weigh these two for yourself and figure out what do you want to do, or what do you think will work best in your scenario, depending on what positions you may be holding, or how many puts you may be holding, and how much delta you want to start with, and so on. If you want to just, normalize everything and say, you know what, everything you're saying makes sense, I'm just not sure exactly where to start, I would say then, you know what, make it consistent. Go with a, 300.1. And the reason why I say 300 is, three better than two, or is it better than four? As far as the width of the spread, we don't know. But one thing I will tell you for sure is that before, when I used 50-point wide put debit spreads for the 112s, those 50-point wide put debit spreads they weren't useless. They were really useful when the market went down kind of slow and we ended up in the trap. Other than that, it had very little hedging property. The spreads, I mean, the strikes in the spreads were too close, which means they offset each other pretty much almost 1-to-1. Right? There's only 50 points between them. So if your long leg is increasing in value, your short leg is losing almost as much value because they're too close. Here you have pretty wide spread, so this spread has a pretty good chance to expand or increase in price if the market's moving with quite a bit of speed, right? So the wider, the better. The flip side is, the wider you want to go, the farther out of the money you have to place this spread, because remember, we only want to spend $25 on it. I know that this may be a little bit too complicated, or it may sound like it's too advanced, but it really isn't. If you just think about, right, if you understand a simple put debit spread, and if you just do a simple exercise, take a 100-point wide put debit spread, and take a 400 or a 500 wide put debit spread, and compare them side by side. Place your long strike at the same exact strike price, and then compare 100 wide to 500 wide. How much delta you get to start with? How much is it going to cost you? How much gamma does it have? How much vega does it have? What if the market went down 5%? How much is 100-point wide worth? How much is 500-point wide worth? Right? Compare the two so that you understand, right? You have two moving parts. You have a 100-point wide and a 500-point wide. And if you understand the difference in how these are going to react under different market conditions, maybe this will kind of help you understand what you need based on what you already have. But if you just want to say, you know what, I want to keep it simple, then I would say, you know what, go with at least a 300 wide, which is much wider than a 50-point spread that I know wasn't really much of a hedge. Go with a 300-point wide, maybe 250, whatever, right? For that dollar amount. If it's $25 or if it's 20, whatever you're willing to spend on that put debit spread, go with that, and then keep the width of that spread the same. Sometimes it's going to be farther out of the money, sometimes it's going to be closer, right? But you're going to be consistent as far as your input. And now we can talk about with duration for this put debit spread. So in this case, I went with 245 or 246 days until expiration. And if my naked puts, let's say I start them off with 56 days. If I start them off with 56 days and I plan on closing them in the last 2 weeks, that's 14 days. So if we go from 56, right, from 56 DTE minus 14 days, that's a 42-day cycle in one trade. If I want to build out maybe 6 tranches of these leftover put debit spreads, 42 times 6, which puts me at about 252. So I need to start with 252 days. And then if I close my naked puts with 14 days until expiration, this is going to leave me with a leftover put debit spread. And then if I do that every 42 days, eventually I will be left with 6 tranches of the leftover put debit spreads. Let's go back and talk about the days until expiration one more time. And maybe I can bring up my pencil here. So we're going to let's just try to break this down, right? So on the naked puts, right? On the naked puts, I'm going to do that naked put maybe 56 DTE. The reason why I chose 56 DTE, or you could be close. It's 53, maybe it's 55, maybe it's 52. If there isn't a 56 DTE put available, there should be one available every Friday. But let's say if you wanted to put on the trade and it's not a Friday, it's a Tuesday. So you have either 56 plus few extra days or 56 minus few days, right? But it's going to be around 56. So if the naked puts are at 56 and I'm going to take them off, right? We put this on at 56 DTE. We're going to take them off at 14 DTE. Right? We take them off at 14 DTE. 56 minus 12. Sorry, 56 minus 14 is 42. So from start from 56 and to finish, right? We're going to look to close out the naked puts at about 14 DTE. There's 42 days. If I want to build 6 layers of these leftover, because remember, if I go with this put debit spread, after I take off the naked puts, this put debit spread will still have time until expiration. I'm not closing this put debit spread, right? So, and if I want to build up a wall of these put debit spreads, I want to have 6 put debit spreads. I want to have 6 put debit spreads, which means I need to run this in about 6 cycles. So 42 times 6 equals 252. Right? 252. So if I start with 252 minus 42, right? One cycle. This is a cycle. We're going to try to take the naked puts off in 42 days. So from 252 minus 42, right? We have 210, which means that when the first tranche of naked puts come off, the leftover put debit spread will have 210 days until expiration. And this leftover put debit spread is going to hedge the next tranche of 112, except the second 112, right, is going to be not just a 112. We're going to have a 1 1 2 plus, right, this is the new trade, plus this leftover 1 1. So now essentially we're going to be in a 2 2 2 trade. And then from this 210 minus 42, right, another cycle goes by. We take off the second tranche of naked puts. We have 168 days. In the first one, the first leftover put debit spreads will have 168 days. The second tranche is going to have 210 days. And then if we add another 112, so now we have one leftover put debit spread, two leftover put debit spread, plus the third tranche. So now we're going to have, instead of 2, 2, 2, right, we're going to have 3, 3, 2. So we'll have 3 put debit spreads with 2 naked puts. And eventually, another cycle goes by, right? Eventually, we'll work our way to having 6, 6, 2, right? We'll have 6 put debit spreads with 2 naked puts. Now, these put debit spreads, right? They are in no way, shape, or form are a hedge that will absolutely save your trades in the event the market goes, down 20, 30%. I mean, it's going to help, right? We go down 30%. Sure, these put debit spreads could potentially be worth a lot of money, but there's going to be a lot of time on these. Your short term naked puts are going to be the most important part that needs to be protected and defended. Right? So we can't say, "Oh, I have so many put debit spreads, market, could fall out of bed and I don't need to do anything." That is the wrong mindset. You have to be always mindful about your risk. Your risk is in your naked puts, naked short options. So you don't want to fall into this false sense that, hey, I have 6 layers of these put debit spreads, everything's going to be beautiful. Maybe it will, but if the market is falling hard, right? These put debit spreads, sure, they're going to help you if this 500 wide put debit spread ends up in the money in 244 days. But what do you think would have happened to your naked puts? How deep in the money are those puts? Right? So no, just because you have multiple layers of these put debit spreads, they're not going to save it all. They're going to help you mitigate losses. They're going to help you reduce your losses. More importantly, what the reason why we're building up these put debit spreads, maybe, if we just continue to, in 42-day cycles, if we continue to take off naked puts, leaving these put debit spreads, eventually these put debit spreads, if they're not used, they're going to expire worthless. If they're expiring worthless, we're not doing anything with these put debit spreads. That means our naked puts are paying us, right? We're generating income and everything is fine. But if the market starts to fall and now we have to move our naked puts out to safety, essentially rolling or buying to close our naked puts at a loss to reestablish a new position with maybe more time until expiration, maybe a little bit farther out of the money. If we're making this adjustment and we're paying a debit, we're going to have to reach for these put debit spreads, which should be increasing in value. If the market's moving lower, these put debit spreads we have to assume that they're going to increase in value, and we're going to start to sell parts or all of these put debit spreads to bring in the credits that we need in order to offset the debits that we have to pay to move our naked puts down and out, or whatever, wherever the safety may be. Right? We can look to, with this, put debit spread, maybe we're, if we needed to make a roll, if we're rolling our naked puts and maybe there's a $300 deficit, right? It's a debit of whatever, $3 debit, right? So we're moving two of them, so it's a $300 debit. Maybe we don't need to close the whole 500 point wide put debit spread. Maybe we can just roll our long leg down. We can also look to maybe roll our short leg up. Whatever is going to bring in a credit, that's what we have to do. Right? Maybe we'll sell -1 at 4,900 and then buy one at 4,800, right? So, which will, right? It's just a 100 point put credit spread on the same expiration where your put debit spreads are, but that's going to bring in a credit, and that credit is going to go towards paying the debit to move the naked puts down and out. Right? And the more put debit spreads you have, the more options you have. Hence, you've got options, right? You have all sorts of different options to defend your naked puts. There was a question last week or something like that where someone said, well, you know what, if the roll is going to cost maybe $500, so can I discount that and take a lesser credit up front, assuming I will have to do a roll? I think the idea is right. We want to automate everything around us, right? In our lives. We want to, everything has to be, on schedule. Everything has to be a part of this, if this, then that. And yes, it's all great. But when it comes, at least for me, when it comes to trading these strategies, I don't know if or when or if at all I will have to move my naked puts. So why would I discount my naked puts to start? Because that's my income part of my business. If I'm going to discount, or if I'm going to take a less credit up front, assuming that I will have to make the adjustment, but what if the underlying never goes down, or my puts never get in trouble where I have to roll them? I just, I lowered my income, assuming I would have to adjust. And to me, that just doesn't make any sense. Right? Can you do it? Maybe, right? Eventually you will have to adjust. But for me, right, I want to collect, let's say if I'm selling a put for $25, and let's just, build out a trade. For example, right? Let's use, again, I went with, and I said, 252 DTE. That is our target days until expiration for the, where is this thing? 252 is our target date for our put debit spreads. But if there is no 252, and let's say I wanted to put on the trade today, I can wait until this 261 becomes 252, right? You can see that. Or I can say, you know what, I'm going to, instead of 252, I'm going to go with a 244. That's pretty close enough. And then I'm going to go with a 300 point wide or 400 point wide. Maybe, let's see what is 5,200 if I buy one of these at 79, and then I'll sell a 400 point. Let's see, that's 52, that's 48 minus 1, right? Where are we? 28, 29. So maybe it's a little bit too much. So maybe 400 is too much. What about 350? Okay, 350 is at 26. close enough, right? So we're going to spend a little bit more. Or if I don't want to do 350, I want to stick with 400, then maybe I need to go to um, push my long puts down 100 points. All right, let's see what does 51 50 47 50, which is 400 points wide. It's going for 27. We can go with, and again, you try different things and find what works best. Maybe 5100. Let's see, 5100, and instead of 4750, we'll go with 5100. Doesn't work. Let's try 5000, and the short is going to be, let's see, 4600. All right, that's going for 21. So maybe we'll keep the 4600 and then we'll just move the long leg. There's 50 points in between these, so it would be helpful if they had a little bit more strikes available. But here's one, 46. So 50 50, 4600 is going for about 25 25, right? So that's pretty close enough. So say, okay, this is the put debit spread for $25. Now we're going to go and look for the expiration for the naked puts, which, I said 56 days. There is no 56 days, not today. 2 days from now, right? Thursday, Friday, this 58 DT will become 56. March 28th is going to become 56 days. Or if I really wanted to put this on today, then you know what? I'll just take a 58 days and then I'll get out instead of 14 DT and get out maybe at 16 DT, whatever the case may be. Right, a couple of days here and there hopefully doesn't make a big difference. Hopefully those extra 2 days aren't going to punish you where the market goes down, 5%. And well, it could happen, yes, but you know, hopefully that's not the case. So few days longer, few days shorter, it doesn't make a big difference. But we are looking for a put to sell that is currently going for about $25 or close to it. Right, maybe a 5550, which is going for 2462, minus two of these, and this is the trade. And if you say, well, this is a little bit too much for my comfort, you don't have to go with, maybe you go, instead of 25, you go with a $20 credit for the naked puts. So you get a little bit more room to the downside, you get a little bit more safety, you get less positive delta, you get less credit up front, right? It's whatever makes most sense for you. That's how you set these trades up. Is this the only way to do it? No, right? You can move your naked puts higher, you can make them farther out of the money, you can give them more time, you can give them less time, right? It's totally up to you. So if I was setting up a trade, I would probably go with something like this. Right. I'm collecting about $25 for two of these, and then I'm spending about $25 for the put debit spread. So net, I'm collecting about $25. This contract has a multiple of 50, not 100. So instead of collecting $2,500 credit, I'm collecting close to, 1250 or 1200 to start. Right. So that's the idea about how to select these um, strikes and expirations. And then if I wanted to, and I'm going to point out one more thing before I let you guys go. If I wanted to collect $25 credit, but I said, you know what, I'm not waiting 60 days or 58 days. I want to go and try to set up a trade with 33 days, 30 days, whatever. Right. And potentially have more than 6 tranches of the leftover put debit spreads. Where's the $25 put? Right, $25 put is a number one. It's a 15 delta or maybe 14 delta, so you're definitely trading much closer at the money, right? The trade we just modeled was somewhere 55.50. This one is at 57.75, so 200 points closer, but you have less time to be in this trade. So there's a trade-off, right? I'm not saying that one is better than the other. You just have to, model different trades and see what works best for you. For me, I think, starting with 56 days and then holding them to about 14 DTE and then getting rid of that naked put for whatever it may be trading and adding another tranche on top of the leftover put debit spread. And this way I get to build up that wall of put debit spreads. That's the way I do it. And, if naked puts get into trouble, we roll them to safety, whichever way. We could try to roll them for a credit, slight credit for even money, right? And if the market is really pressing and if we're forced to roll and actually pay a debit, then we go and look, what can we sell, assuming we have a large number of leftover put debit spreads. We'll look, what can we sell in order to raise the money we need to cover the debit if we are rolling the naked puts down and out and we have to pay a debit for it. All right. So hopefully this is something that you find useful. Hopefully I get you to think a little bit about this. If you have any questions, you can put this on Discord. Would love to talk more about this. And I'll post this recording and I'll see you guys. I'll be back on Friday. So have a good day. I'll talk to you guys then. Bye-bye.